Hello and welcome to demonstration video number 2 for Learning Plan 2 Chapter 12. And this demo video will be on trading securities. I will be demonstrating exercise 12-4, 12-7, and 12-8. And this is going to start on page 706. So what I'm going to do, like I did before, is have exercise 12-4 here, 12-7 here, and 12-8 here. So that's how I'm going to do that. So hopefully you have your book with you, follow along, and you can also use this to help you with the assigned homework as well as the practice homework. So let's start with 12-4. Try to blow this up a little bit here. Let's make it 130. Okay, there you go. All right, in 12-4 on page 706. I lied. I meant 706, not 704. There we go. Shop Farm Supplies Corporation purchased 800 shares of General Motors stock at $50 per share and paid a brokerage fee of $1,200. 2 months later, the shares were sold for $53 per share, and the brokerage fee on the sale was $1,300. Prepare entries for the purchase and the sale. Okay, so remember that any brokerage fees that were included in the sale is also included in that price of those shares. So let's go ahead and demonstrate that. So for the first journal entry then, for the purchase, we're going to call this investment in GM common shares. It doesn't have to necessarily be the exact name. Every company, like I said before, is going to be a little different. And then we paid cash. All right, so it'd be 1,800 shares times the $50 per share. And we're going to add the $1,200 in the fees, the brokerage fees. So that gets us to 41,200. Okay, so that's that one. That was for the purchase of the investment. And looks like they sold it 2 months later at $53 per share. So if we sold it, we know we're going to get cash in. So let's see here. Sale entries. Right, so we're going to debit cash because we know if we sold an investment, we're going to cash in. And that's going to be the 1,800 shares. At $53 per share. But they did also get have $1,300 in the fees. Okay, so if we do that math, they'll come out to $41,100. We know that we have to take the investment off the books. The investment will be the same amount as what we paid for, okay, because it's recorded at cost in our financial statements. So it looks like if it doesn't exactly, debits don't exactly equal credits, so we know that we are either going to record a gain or a loss in here. So basically, since our debits are lower than our credits, we know that we have a loss on sale of investments. And that's basically just going to be our difference of $100. Okay, so we had a loss on the investment of $100 based on this sale right here. I should There you go. So it looks a little better. Okay, so that's it for 12-4. Basically what we did was we made an entry for the purchase of some shares in General Motors, and then we went ahead and 2 months later sold the shares, of course at a little higher rate, but because we had some brokerage fees in there as well. This is not a subtraction, this is an addition. There we go. And looks like fees. Oh yeah, that's right. Yep. Okay. So basically we made the sales for entries for the sale 2 months later with the loss of $100. Okay, so that's that one. All right, so let's move on to 12-7, and that's in this next tab. And I went ahead and copied down what was in that exercise already. In the exercise, it's talking about L'Oreal American Corporation. They purchased several marketable securities during 2013. At December 31st, 2013, the company had the investments in common stock listed below, which is what I have here on the screen. None was held at the last reporting period, December 31st, 2012, and all are considered securities available for sale. All right, so we've got a few different investments here. We got some short-term investments for Blair Inc., ACN Corporation, and then we got some long-term investments here for Drake Corporation and Air Industries. And because these are all considered as securities available for sale, they have to be adjusted at the end of each reporting period at its fair value. So you can see here that each one has the cost, each investment has the cost listed, the fair value at the end of that reporting period for each investment, and then the adjustment or the unrealized holding, the gain or the loss at the end of each period. Okay. All right, so let me just kind of lay everything out for you so that you can understand how this works. A really good example to look at, and if you need more further explanation on top of this video, if you read page 661, it does show you step by step on how to do this as well. And the book has a good example on top of this example, and hopefully the practice problem, you'll get a better understanding of this. But what we're going to be doing now is we're going to be looking at each cost, the fair value, and then adjusting each, or basically going in and making an adjusting entry to the fair value of the investments. And basically, and I just kind of want to talk a little bit about HTM securities. Well, unlike HTM securities, I want to talk a little bit about the trading securities. They're basically carried at their fair value, which is this amount. It's carried in the balance sheet, so the carrying value must be adjusted to the fair value at the end of every reporting period, and that is what we are doing here. So rather than increasing or decreasing that investment account itself, we use a valuation allowance account called fair value adjustment, and I'll show you that we will be crediting that fair value adjustment account in a little bit when we do the adjustment. All right, so let's go ahead and go in. We know that because all this information is given to us, we know that at the end for the short term, we know that we have to do the fair value adjustment for short terms by $45,000. And we know that we have to adjust the long-term investments by $20,000, okay? This will be a decrease and this will be an increase. Well, basically, we can net them together. So we get the $45,000 minus the $20,000. That gives us a $25,000 adjustment. Okay, so we know that we have to, based on all of our investments, because they are trading securities available for sale, they have to be reported at the fair value, and we've already determined that our short term has to be decreased by 45,000 and our long term has to be increased by 20,000. Okay, so basically let's go in and make that entry. So I'm going to debit my net unrealized holding gains and losses, OCI, for the 25,000. Okay, and I have to credit my fair value adjustment for 25,000. Okay, so right now, and I'll show you my T account here so that you kind of see what's going on. So for the fair value adjustment account, we've got a credit balance of $25,000. Okay, so how this $25,000 will go into, we'll go ahead and decrease our comprehensive income. It can be reported under the comprehensive income section as other comprehensive income, or it can be reported as a separate statement of comprehensive income. And that is basically the answer to number 2, requirement 2. For requirement 2, it asks what amounts would be reported in the income statement at December 31st, 2013 as a result of the adjusting entry. Well, none will be reported in the income statement section, okay, because the income statement is a separate statement, if I can type here, from the comprehensive income statement. Okay, so basically, accumulated net holding gains and losses for securities available for sale are reported as a component of shareholders' equity in accumulated other comprehensive income, and changes in the balance sheet are reported as other comprehensive income or loss in the statement of comprehensive income rather than as part of earnings. So this statement can be reported either as, so basically as a combined, I'm going to write this down for you here, it's a combined statement of comprehensive income that includes net income and other comprehensive income, or B, it can be reported as a separate statement of comprehensive income. Okay, so that's basically what we do for this exercise. We were looking for how to adjust the fair value adjustment based on fair values given for that ending reporting period. We adjusted the investments based on what we came out with, and we came to the conclusion that that 25,000 will not be reported in the income statement at the end of December 31st, 2013, but it can be reported as a combined statement of comprehensive income that includes net income and other comprehensive income, or as a separate statement of comprehensive income. Okay, so that's that one. All right, so moving on to 12-8. -8 is on page 707. All right, on February 18, 2013, Union Corporation purchased 10,000 shares of IBM common stock as a long-term investment at $60 per share. On December 31st, 2013 and December 31st, 2014, the market value of IBM stock is $58 and $61 per share respectively. Requirement 1 is asking what is the appropriate reporting category for this investment and why. Okay, so first of all, I guess I can write this down so you, requirement 1, the statement can be reported either as a combined statement of comprehensive income that includes net income and other comprehensive income, or B, like before, previous one, as a separate statement of comprehensive income. And remember that accumulated net holding gains and losses for securities available for sale are reported as a separate component of shareholders' equity in the balance sheet. And just a little bit more information on the securities that are held to maturity. They are debt securities that an investor has or in mind the positive intent and ability to hold that investment till maturity. Okay, actively traded investments in debt or equity securities acquired principally for the purpose of selling them in the near future are classified as trading securities. So basically the IBM shares are neither. They're classified as available for sale. So since all investments in debt and equity securities that didn't or don't fit the definition of other reporting categories are classified this way. And of course the equity method isn't appropriate either because 10,000 shares of IBM certainly don't constitute significant influence. So basically that was requirement 1. And then requirement 2 then. Okay. I'm going to try to make this a little bigger. In requirement 2, they're asking for prepare the adjusting entry for December 31st, 2013. Okay, so at December 31st, 2013, okay, the shares were initially bought at $60, but at the end of December 31st, 2013, the market value states $58. So we know that we have to decrease the fair value adjustment by $20,000. The way I know that is because it was initially bought at $60 and now it's at $58. Okay, that means there's a $2 difference. So I've got to debit net unrealized gains and losses for $20,000. Okay. It's 10,000 shares at $2 a share. Okay. And remember, we have to credit fair value adjustment for $20,000. All right. So this is our requirement 2 adjustment for the market value amount at $58. Cost was $68, but because fair market value says $58, excuse me, cost is $60, but fair market value says $58, we have to adjust it for the fair market value of $20,000. Okay. Requirement 3. Prepare the adjusted entry for December 31st, 2014. And so in the problem, it says that at the end of December 31st, 2014, the shares were $61 per share. Okay. So to look to, let's see, let me just go ahead and do the t-value for the fair value adjustment account over here, so you kind of see what's going on in the account and hopefully you understand it better. But right now we've got a $20,000 balance in this account. Okay. It needs to get to 10,000. And how do we know that it needs to get to 10,000? Well, initially, okay, this is all right. Okay. Anyway, okay, so in requirement 3, the cost is 60,000, but right now it's at 61. Did I say 60,000? I meant $60. At the end of 2014, it is now $61. So we know that we have a $10 or $1 gain, okay? But as of right now, we've got that adjustment in there as a $20,000 negative balance. We got to get it to a positive $10,000, okay? So the way we would do this is you would actually, I'm just going to do this here. No, that's not going to work. Okay, let's just write it out. So the net unrealized gains and losses is going to be 10,000 shares at $3. Okay, why is it $3 and not $1? Well, basically, remember the year before it was at it was adjusted to $58 per share. Now this year, to determine what we need to have in the fair value adjustment, we have to take the initial cost, which is the 60,000, minus the fair value of the current year, which is then 60 minus the 61. We have to have $10,000 in there. That's just to find out what we need in the fair value adjustment account. To find out what to be able to find out what the adjustment account amount will be, we've got to take the previous year fair value amount, which is the $58 here, and I can do it here, minus the 61, that would equals 3, okay, equal $3. So that would be the 30,000. So we would credit net unrealized holding and gains net okay, this would be better. Oops. Fair value adjustment, which is the 10,000 shares $61 minus is 58 for 30,000. All right, so right now, if you go ahead and put that 30,000 in here, from this entry. Let's see, I'm just going to do this so that once you print this out, you can remember how I got that number. Get out of there. Okay, there we go. All right, so I know I need to get to 10,000. I've got 20,000 in this fair value adjustment account right now. And just to double check, you know, I know that I was at $58 per share last year in 2013. In 2014, it's at 61. That would be a $30,000 adjustment to my fair value adjustment account, which then equals the $10,000 gain in the fair value adjustment account. So that's how you do that one. So I'm hoping that by the end of this and hoping reading the information on page 661, it will help you better on how to understand this concept. Hopefully, if we had given you another example for, let's say, the next year of 2015 with a fair value of, with a market value of, let's say, $62 from 61, you will understand how to do it. But so far, this is what we're going to have. And so far, this is what we have for the trading securities. So basically 12-12, 12-4 here, 12-7, and 12-8. Make sure that you watch, make sure you go ahead and do the practice problems before you go ahead and attempt the graded problem. So that's it for this video. There is one more video for this learning plan. It will be involving the problems 12-2, 3, and 5, and I'll demonstrate that in the next video. But I will also attach these notes to the second video so that you will have that for your reference when you start doing the practice problems or the graded problems.